In today's world, more and more people are becoming aware of the importance of investing. But awareness alone isn't enough. Often, that knowledge never turns into action, either due to confusion, lack of clarity, or the fear of making mistakes. The result? Many stay stuck at the starting line, never taking the first step toward building wealth. But what if you had a mentor, someone, to simplify the financial world for you? Break it down into easy-to-understand lessons and give you the confidence to invest wisely? Wouldn't that change everything? Well, today's book summary might just feel like that guiding voice. Hi, and welcome to Audiobook 101, the place where you don't just listen to summaries, you live them. Every book here is your stepping stone to a better version of yourself. Today, we're diving into the Essays of Warren Buffett, Lessons for Corporate America, a timeless collection of wisdom compiled and edited by Lawrence A. Cunningham. This book brings together the legendary letters Warren Buffett wrote to his shareholders over the years, letters that are more than just reports. They're filled with stories, insights, and practical advice straight from one of the world's most successful investors. These aren't just random thoughts. They're Buffett's deeply personal reflections on business, investment strategy, corporate governance, taxation, accounting, mergers, acquisitions, and more. If you've ever wanted to understand how a billionaire thinks about money, business, and decision-making, you're in the right place. And thanks to Lawrence Cunningham's thoughtful arrangement, these letters are presented in a way that's not just educational, but enjoyable and accessible, even if you're new to investing. So, let's begin this journey into the mind of Warren Buffett and discover the timeless lessons that continue to shape the world of finance today. Corporate governance. At Berkshire Hathaway, Warren Buffett doesn't just talk about investment, he also openly shares how he runs his company and the values behind its operations. In this part of the book, Buffett draws a sharp contrast between Berkshire's annual shareholder meetings and those held by many other corporations. According to Buffett, most corporate meetings are, frankly, a waste of time. They tend to be filled with surface-level discussions where shareholders are more interested in their personal concerns than the actual business. The conversation drifts away from real financial discussions, and the level of engagement continues to decline year after year. Those who are truly business-minded often avoid these meetings altogether, because who wants to sit in a room where complaints drown out clarity? Now contrast that with Berkshire Hathaway's annual meetings. They're a completely different experience. Buffett, as the CEO, and his partner Charlie Munger, the vice chairman, answer every single question, no matter how long it takes. What makes these meetings special is the honest, meaningful dialogue centered around the business itself. Their top priority is to provide shareholders with useful, accurate information, just the kind of transparency they'd expect if the roles were reversed. Buffett emphasizes this. If he were in your place, he'd want complete clarity about the company's operations. That's why honesty is the first policy at Berkshire. Investors deserve to know the true financial condition of the business. If the leadership isn't open about that, how can anyone make a well-informed decision? He also cautions against unclear accounting practices. When a company uses vague or overly complex financial methods, it raises red flags. It suggests the management may be hiding something. Buffett prefers a company that communicates openly and clearly about its performance, just as Berkshire does. Unfortunately, many large corporations selectively present only the information that casts them in a positive light. They filter out anything that might damage their reputation, creating an illusion of strength. Buffett sees this as a dangerous practice, especially when CEOs start predicting unrealistic growth rates for their companies. For example, a CEO promising 15% annual growth might sound confident, but such numbers can be overly optimistic, if not outright misleading. Buffett warns investors to be cautious with such claims. Before putting their money into any company, they should examine whether its accounting practices are sound. Weak accounting often hides behind unclear reports or confusing statistics, signs that the company may not be as transparent as it appears. He also advises readers to pay attention to the fine print, the footnotes in financial reports. If they're too difficult to understand, it may not be a coincidence. In some cases, it's a deliberate attempt by leadership to obscure the truth. Another red flag is when CEOs make bold promises about future earnings. The truth is, no one can guarantee future returns. Investing always involves risk, and while we can hope for great outcomes, there's never a guarantee. Buffett also shares his concern about how CEOs are held accountable, or rather, how often they are not. In most roles, performance standards are clear. For example, a secretary must be able to type a certain number of words per minute. If they can't meet the standard, they don't get the job. But with CEOs, there's often no clear benchmark. Worse, there's often no one above them to evaluate their performance. This is how many underqualified people end up running major corporations and stay in power far longer than they should. Buffett also addresses the topic of charitable contributions. He criticizes the fact that in many companies, about half of all charitable giving is decided by directors without consulting shareholders. To him, this feels wrong. Imagine how a director would feel if the roles were reversed, if an owner reached into their pocket and decided where their money should go. Buffett believes charitable donations should first align with the business, and any remaining funds should be donated based on shareholder preferences, not just executive decisions. Ultimately, he believes in a system where managers can be trusted, but the final say should always rest with the owners. That's exactly the model followed at Berkshire. When it comes to risk control, Buffett makes one thing clear. It's the CEO's personal responsibility. If a CEO refuses to take responsibility for risk management, they don't deserve to hold the position. Buffett puts it simply, we can afford to lose money, but we can't afford to lose our reputation. That's the guiding principle behind his risk control strategy. Of course, no CEO can monitor every single employee. With over 250,000 people working at Berkshire, it's unrealistic to expect perfect behavior from everyone. But what matters is how leadership responds when something goes wrong. Buffett's philosophy is to act immediately and decisively the moment a problem comes to light. Finance and investing. In this chapter, Warren Buffett explains his approach to long-term investment, emphasizing the importance of focusing on the business itself rather than the market or timing. He also discusses diversification and arbitrage. Buffett shares that throughout his career, whenever he has purchased stocks for Berkshire Hathaway, he has always done so with the company's long-term economic prospects in mind, not by trying to time the market. He doesn't concern himself with market fluctuations or the right time to invest. Instead, he looks for stocks that he is confident will help him build profits over time. If he senses that a stock may cause short-term losses, he doesn't stress about it. For Buffett, the key is long-term advantage. He doesn't see himself as a market analyst, but as a business analyst. He doesn't invest based on the market's position. Rather, he invests when he's certain that the stock will provide him with good returns. To better understand this, Buffett uses the concept of Mr. Market, a metaphor for the stock market. Mr. Market is like a person with serious emotional problems, sometimes overly optimistic, inflating stock prices, and other times extremely depressed, causing stock prices to drop. But here's the catch. Mr. Market doesn't care if you ignore him. If today's prices don't interest you, he'll come back tomorrow with new prices and opportunities. This metaphor helps us understand that the market can often be irrational. But as long as you don't let emotions guide your investment decisions, you can take advantage of these irrational movements. If the market is undervaluing a business, it gives you an opportunity to buy at a better price. Buffett points out that many investors, especially short-term ones, get excited when stock prices rise. However, he finds no logic in this. He draws a parallel with a person who loves hamburgers. Would they be happier when beef prices rise or fall? Clearly, they would be happier when beef prices drop. Similarly, short-term investors are happy when stock prices rise and depressed when they fall. As a long-term investor, Buffett focuses on sinking prices when stocks are undervalued, rather than soaring prices when they're overpriced. If he doesn't find a good investment opportunity, he often turns to arbitrage. Arbitrage involves buying stocks in one market and selling them in another, taking advantage of price discrepancies between markets. For example, if gold prices suddenly fall in Japan, a smart investor might buy gold at a lower price there and sell it at a higher price in New York. Even small price differences, such as between London's pound and New York's dollar, can provide opportunities for profit. Buffett advises investors to avoid sticking to one specific investment style. Instead, they should evaluate facts independently and make informed decisions based on research. Your goal as an investor is to find great businesses at reasonable prices. It's not about finding mediocre businesses at lower prices. Buffett doesn't believe in diversification simply for the sake of it. Diversification means expanding a business into a completely new market segment, one that has no connection to the company's existing products. Buffett prefers to invest in what he knows. He only invests in businesses that align with his knowledge and interests, and he only invests when he is confident in the management's trustworthiness. Many people diversify based on a stock's beta, which measures how much risk is involved in investing in that stock. For example, a beta of 1.5 means there's a 1.5% risk of change in returns. However, Buffett believes that making investment decisions based solely on beta is misguided. To find a great stock, you must determine a company's true value regardless of its market position. This research helps investors succeed in the stock market. By working hard to uncover a company's true worth, an investor can profit in ways that beta values won't reveal. Remember, Buffett says, don't diversify for the sake of it. Only invest in stocks that you truly understand. In the end, the key to success isn't to be swayed by the market's influence, but to make independent decisions based on your own research. Investment alternatives. In this chapter, Warren Buffett explains the different types of investments by dividing them into three broad categories. He compares them, discusses the risks associated with each, and shares why some are more promising than others. He also reflects on the popularity of junk bonds and airline stocks, and wraps up with his thoughts on share repurchasing and why future investment returns may decline. Buffett begins by classifying investments into three types. The first category includes currency-based investments, like bonds, mortgages, or bank deposits. People often believe these are the safest options, assuming there's little to no risk involved. But the truth, Buffett says, is quite the opposite. These investments are vulnerable, not necessarily to direct loss of money, but to the erosion of purchasing power due to inflation. Over time, the value of money declines. What used to cost $1 might now cost 20. Governments control the value of currency, and inflation can quietly eat away at your returns. Though higher interest rates might sometimes offset this, that's rare. That's why Buffett doesn't favor currency-based investments. He believes they may look safe, but can silently diminish your wealth over time. The second category includes assets that don't produce any income themselves, but are bought with the hope that their price will rise in the future. What kind of investment fits this description? Gold? Gold doesn't produce anything. It just sits there. It doesn't create value or cash flow. Its demand is limited, and yet people continue to buy it, hoping that someone will pay more for it in the future. To Buffett, this kind of speculation lacks real substance. The third category, and Buffett's personal favorite, includes productive assets. These are things like businesses, farms, or real estate. Assets that generate income and create value over time. They require a relatively small amount of capital to start with, but have the potential for strong long-term returns. After carefully evaluating all three types, Buffett concludes that productive assets significantly outperform the other two. But not everyone sees it that way. He notes that people still invest in junk bonds, which are essentially loans made to borrowers with poor credit ratings. It sounds odd, doesn't it? Investing in debt issued by institutions that have a track record of not paying back. A low credit rating indicates that lenders have previously struggled to recover their money from these borrowers. To attract investors, these institutions offer higher interest rates, but that higher return comes with greater risk and often substantial losses. Junk bonds became wildly popular in the 1980s, but many investors who were drawn in by the allure of high returns ended up with heavy losses. Buffett then shares a humorous anecdote. When Richard Branson, founder of Virgin Airlines, was once asked how to become a millionaire, he joked, "You start out as a billionaire and then buy an airline." That's how risky the airline business can be. Buffett admits that he too once invested in an airline company and made a mistake. On paper, everything looked great. The financial reports were solid. But he overlooked one key factor, the extreme competitiveness of the airline industry. No matter how good the numbers are, if the market is too aggressive, profit margins shrink and losses mount. That's exactly what happened. This experience taught Buffett that greed and fear are part of every investment decision. He gives a powerful piece of advice. Be fearful when others are greedy, and be greedy when others are fearful. In other words, if everyone is investing enthusiastically, it might be time for you to pause. But when others are too scared to invest, that might be your best opportunity. This may sound counterintuitive, especially since U.S. businesses are currently doing well, yet investment returns are declining. Why is that happening? Buffett explains with a simple analogy. Imagine a single family owns every American corporation. Over generations, they would grow incredibly wealthy just by owning and running these businesses. But eventually, helpers arrive, consultants, advisors, and managers suggesting that parts of the business be sold or managed differently for a fee. Gradually, the family's wealth starts to leak away, not because the businesses are failing, but because they're now paying others to manage what they once ran themselves. More advisors arrive, offering professional help for even more fees. The more the family outsources, the more its wealth erodes. What was once a powerful, self-sufficient enterprise becomes dependent on costly assistance. This scenario is exactly what happens when investors turn to private equity firms or hedge funds. They hand over their investments to managers who charge substantial fees, ultimately reducing the investor's actual returns, even if the businesses are performing well. So, despite holding strong assets, investors are forced to settle for less because so much is paid out in management costs. As for Buffett's own company, Berkshire Hathaway, he says he and his partner Charlie Munger have two main goals. First, they never want to overvalue their company. They want its reported performance to reflect its real worth. And second, they aim to build long-term partnerships. Frequent changes in shareholder ownership are discouraging, much like people constantly leaving a school or church community. Buffett wants shareholders who are in it for the long haul, people who trust the process and the leadership. Finally, Buffett touches on the concept of share repurchasing. When a company buys back its own shares, it often means that the company believes its stock is undervalued, that its true worth is higher than what the market reflects. And if the leadership truly believes in the company's future, that's a positive sign. Many of Buffett's own shareholders have urged him to repurchase Berkshire Hathaway shares. And although he admits there were times he should have, he maintains a clear rule. He will only buy back shares if they fall significantly below their true intrinsic value. Otherwise, he prefers to wait. Mergers and acquisitions. In this chapter, Warren Buffett shares his approach to mergers and acquisitions, how he evaluates businesses, what he looks for in potential acquisitions, and the importance of understanding intrinsic value over surface-level numbers. Buffett says one of his favorite activities is acquiring high-quality businesses with strong economic foundations. He and his longtime partner, Charlie Munger, search for companies the way someone might look for a life partner. When you're patient, open-minded, and genuinely interested, the right match often appears. But if you rush the process, you're more likely to make poor decisions. Just like a rushed marriage can lead to regret, hastily choosing a business to acquire can be costly. In his early days, Buffett admits to making this mistake. He sometimes bought companies simply because their ratings looked good, even if the businesses themselves weren't. Over time, he refined his strategy and began acquiring only those companies that were fundamentally sound, even if others didn't yet recognize their value. For Buffett, commitment matters. He avoids short-term investments. If he decides to acquire a company, it's with a long-term relationship in mind. When it comes to merging with another company, Buffett is guided by a strict principle. He won't issue shares unless what he's getting in return is of equal or greater intrinsic value. And he poses a simple question to drive the point home. Why would anyone trade $5 for 5 cents? Mergers only make sense if the true worth of the assets being acquired matches or exceeds what's being given up. He also touches on a type of acquisition known as a leveraged buyout, where borrowed money is used to finance the purchase. Buffett shares a clever analogy to caution against these kinds of deals. Imagine a man takes his lame horse to a vet and says, "Sometimes it walks fine, and sometimes it limps." The vet replies, "Then sell it while it's walking fine." That's exactly what some corporations do. They try to sell while they're still performing well, hiding deeper issues from potential buyers. That's why Buffett is cautious. Before acquiring any company, he ensures he can keep the current owner on board as a manager. He prefers businesses built with care and love, run by people who want to stay involved even after the sale. These owners aren't just selling for profit. They're looking for continuity and stewardship. That kind of long-term mindset aligns perfectly with Buffett's philosophy. He stresses the importance of understanding accounting figures. While most people avoid financial statements, Buffett believes you must examine them carefully. One key concept to grasp is intrinsic value, the estimated worth of a company's assets without accounting for unpredictable future complications. It's not an exact figure, but a reasonable estimate. If two investors are looking at the same data, their intrinsic value calculations will likely be similar. Interestingly, Berkshire Hathaway doesn't include this number in its official reports. Instead, they provide all the raw data so shareholders can calculate it themselves. They do report book value per share, but Buffett notes that this figure has limited usefulness. It's just the ratio of a company's total assets, excluding debts and liabilities, to the number of outstanding shares. This number often differs significantly from a company's actual intrinsic value. Buffett explains that Berkshire is unique in this regard. Its intrinsic value is easier to estimate because of its steady earnings and minimal debt. That stability gives shareholders a clearer picture than they might get from other companies. But if financial figures can sometimes be misleading, how can you determine real value? The answer, Buffett says, is in the earnings. Look at what a company is currently earning. Then consider what those earnings could realistically grow into over the coming years. For Buffett, understanding the company's long-term direction is more important than what's printed in the latest annual report. He also references the Black-Scholes model, a widely used formula to calculate theoretical value or fair price. Though the model can produce strange results when applied over long periods, Buffett and Charlie still include it in their financial statements. Why? Because it's a standard taught in most business schools. Omitting it might raise doubts about their transparency, even though it's not perfect. Accounting Shenanigans. In this chapter, Warren Buffett uncovers how certain accounting practices are used or misused by companies to mislead investors. He emphasizes the importance of staying alert and informed because not everything in a company's financial report is as honest as it seems. Buffett explains that no matter what accounting method is used to report a company's data, there are three essential questions every investor must ask. 1. What is the true value of the business? 2. Can it meet its future obligations? 3. How competent and trustworthy is the management? Most companies follow a set of rules called GAAP, Generally Accepted Accounting Principles. These are designed to standardize financial reporting. However, Buffett warns that GAAP alone cannot answer the three questions above. In fact, some companies cleverly manipulate GAAP-compliant figures to deceive investors. They present numbers in a way that appears legitimate under GAAP, while actually hiding critical weaknesses. One common tactic involves manipulating net income, one of the most widely followed financial indicators. At Berkshire Hathaway, Buffett and Charlie Munger could legally shape net income into any number they like just by adjusting certain inputs. For example, net income includes realized profits, but not unrealized gains, potential profits that exist only on paper. While Berkshire avoids manipulating these figures, Buffett warns that other corporations often do. Another trick companies use is something called a restructuring charge. This is meant to be a one-time cost incurred when a company reorganizes its business. While legal in nature, this practice is sometimes abused. Losses that have been building up for years are blamed on a single event. This allows companies to clean up their past performance and create the illusion of steady improvement. Buffett compares this to a golfer who typically scores around 80 but suddenly has a terrible round with a score of 140. To cover it up, he goes to a golf shop, restructures his swing, and then returns with slightly worse than average but more consistent scores like 91, 94, 89, and 92. To an outsider, it looks like the golfer has improved. Similarly, investors may be misled into thinking the company is doing well, when in fact, it's just covering up old damage with cosmetic changes. When companies are acquired, two main techniques are used to handle accounting: purchase accounting and pooling of interests. In purchase accounting, assets and liabilities are recorded at their current fair value. In pooling, they are recorded at book value, the original price when the asset was bought. However, the Financial Accounting Standards Board, FASB, has now banned the pooling method due to its potential for misuse. Buffett also notes changes in GAAP regulations that now require companies to disclose much more detailed segment data, particularly for subsidiaries. In the past, companies could summarize their entire operations in a single figure. Now, they are expected to break it down and include tax obligations and other future liabilities, like pension responsibilities. This shift significantly changes how a company's balance sheet is calculated and interpreted. These complexities in financial reporting make it easier than ever for companies to manipulate data and mislead investors. That's why Buffett believes it's essential for investors to educate themselves about accounting practices. Understanding what's beneath the surface gives you the power to see through the illusion and make smarter, safer investment decisions. Tax matters. In this chapter, Warren Buffett discusses tax reforms and how changes in tax laws impact both corporations and consumers. He reflects on the 1986 Tax Reform Act and its effects on businesses like Berkshire Hathaway. According to Buffett, while the reform introduced some praiseworthy adjustments, its overall impact on Berkshire was more negative than positive. For one, the new policies slowed down business growth. But more importantly, they significantly affected shareholder returns. Where previously every dollar earned would leave 80 cents after taxes, now only 72 cents remain, thanks to the tax rate increasing from 20% to 28%. Berkshire's own corporate tax rate on ordinary income, such as salaries, tips, or rent, shifted from 46% to 34%, which might sound positive, but the broader implications weren't entirely favorable. Some people believe that consumers bear the full burden of taxes. Others argue that corporations pay the taxes, and consumers are mostly unaffected. But Buffett makes one thing clear: it depends. In some cases, lower corporate taxes benefit shareholders directly, while consumers see little change. In other cases, corporations pass tax burdens onto their customers, raising prices and diminishing consumer value. The outcome varies based on two things: how powerful the business is and whether it is regulated. A regulated business, like an electric utility, is subject to government oversight. If tax rates drop in such an industry, so will the prices customers pay. However, if the business is unregulated, the benefits of lower taxes mostly go to the corporation and its shareholders. At Berkshire, many of the companies they own operate in unregulated markets. So, the financial gain from tax reductions often lands in Berkshire's pocket, not the customer's. Buffett gives a striking example to make this point clear. Imagine a brain surgeon in your area. If taxes fall, would you expect the cost of brain surgery to drop by 50%? Probably not. The same logic applies to businesses. Just because Taxes are lowered doesn't mean those savings are passed on to consumers. Instead, they often increase the owner's profits. Another change Buffett highlights is the rise in the capital gains tax from 28% to 34%. Capital gains are profits made from selling assets that may not generate income now but hold potential for future value. This tax hike was unfavorable for Berkshire because the company relies heavily on long-term capital gains from its investments. To illustrate, Buffett cites three major investment holdings: Capital Cities, GEICO, and the Washington Post. Combined, their market value was around $1.7 billion, yet their annual return at the time was just $9 million. Clearly, Berkshire wasn't investing for the immediate returns, but for the long-term capital appreciation. And heavier taxes on those gains directly reduce their overall earnings by as much as 10%. Despite this, Buffett and Charlie Munger don't complain. They understand the long-term value of their efforts and how smart tax planning can help them maximize profitability. In fact, rather than acquiring just a few shares of a company, they prefer acquiring the entire company, 100% ownership when possible. Thanks to favorable tax laws, owning a full stake can be far more profitable than partial ownership. Buffett believes that if their taxes are increasing, it simply means their company is doing well, and that's a sign of success. More taxes often signal more wealth, and he's perfectly fine with that trade-off. Conclusion. This summary is a rich collection of insightful and invaluable letters written by Warren Buffett to his shareholders, letters that now stand as timeless lessons on finance, business, and investment strategy. Each one carries the weight of Buffett's experience, wisdom, and real-world understanding of how money and markets truly work. For any investor, whether you're just starting out or already experienced, this book serves as a guiding light. It doesn't just share theories. It offers the lived perspective of one of the world's most successful investors. Through these letters, you get to see how Buffett approaches crucial topics like taxes, mergers, acquisitions, and financial decision-making, not just in theory, but in practice. What makes this book even more powerful is the way these essays are arranged. Editor Lawrence Cunningham has structured them thoughtfully so readers can absorb Buffett's principles in a clear and progressive way. Whether you're looking to deepen your investment knowledge, sharpen your financial judgment, or simply understand how a billionaire thinks, this book is a treasure trove. In the end, these essays do more than inform. They mentor. And once you've absorbed the lessons within, you'll start to see the investment world through a sharper, more confident lens, just as Warren Buffett intended.